Great. Well, a very good afternoon. I've got all my screens set up now. Welcome to Forex Source live webinar with myself, Giles Coughlin, one of the senior commentary analysts here. It's good to have you on board, and thank you very much for taking time out of your day to join me. And we're going to get kicking off straight away with our Aussie US dollar currency pair. Now, looking at the Aussie US dollar currency pair, this is our dominant currency sentiment pair for the day. Now, the reason we have the dominant currency sentiment on this currency pair is for a number of reasons. First of all, we've had a little bit of a risk-off tone that's come back into the market as a result of US Senate passing a bill yesterday which has the potential, rather, to limit Chinese companies from actually being listed on US exchanges. So this bill means that some Chinese companies may actually, in fact, have to delist from some US exchanges. And there was also some news that there's some way of tightening regulations on global chip sales to Huawei Technologies. And also we've had Chinese comments pushing back against the US to do with their involvement with Taiwan. Now, the issue that hurt risk sentiment yesterday afternoon was particularly when the US Senate passed a bill. And the reason this was more serious is because the markets got used to President Trump saying, pretty outlandish things. So his commentary on the US and China trade dispute has become, almost like second hand. They're used to a war of words. However, with the US Senate passing a bill, it's indication that the war of words has gone into some action. So just trying to understand the risk sentiment this week, the positive driver has been the news from the Moderna company that they've got some potentially good results of a trial. Now, there's some question marks about how good those results are by Stat News earlier in the week, but the market's focused on that this is basically good COVID-19 news. So that's why we've seen some strong risk-on sentiment going on. Now, just to be aware, it was these US-China action by the US Senate, the actual action is the key bit. It's the bill being passed that could actually impact. So that's a little clue as to what's going to be moving the market in these US-China trade disputes. Rhetoric is less likely to use the market. Obviously, it depends what the rhetoric is. So if it's very inflammatory, it still could move the market. But if it's just, what we're used to from President Trump, then we can expect that to be largely ignored. But when it becomes action like the US Senate bill, as we now currently have, which is why this is our dominant currency sentiment today, that's why it's resulted in some dollar strength. So just taking a look at the dollar, we saw some dollar strength coming off of those lows. And that was a result of this, the risk off flows coming into the US dollar. So today, we still have that mood in the market. Furthermore, we also have some negative comments from China towards Australia, because Australia sort of really irked China, saying that they wanted to have a proper investigation into the outbreak of the COVID-19 virus, and that ticked China off. So they started putting tariffs and sort of raising questions about imports from Australia into China, and they sort of said, China has the possibility to really hurt the Australia's economy, but it won't do so kind of unless provoked. So it's a kind of not very subtle warning of back off. So we also expect the Australian dollar to fall on the risk-off tones anyway. So there's reasons to expect US dollar strength. There's reasons to expect Australian dollar weakness. So therefore, we have an Aussie US dollar bias. So that can be sold from market and looking to take profit just down in this support region, just above the 6,530 level. So that is an opportunity for today. And the risk off tone is remaining. So we'll just have a quick look through the markets just to see how we analyze risk markets. Very helpful skill for you to develop yourself. so that you know, just do this by second nature. It will really help you in the long term. So have a look at the equity markets. We can see that European equity markets are broadly lower. Asia was broadly lower. We've got S&P 500 Dow futures lower. So the US is looking at heading into a lower open. We're also seeing some downside in treasuries. So bond yields are lower. We also now have the oil complex, WTI and Brent crude, have been supported on those falling inventory levels. So the headline inventory levels fell, and in the end, the market focused on that. And it was a mix. It was kind of a mixed report. So the headline inventories fell, so the market's just taken that as positive and bought up the oil markets on that positive data point. You can see copper prices are currently ranging. Gold keeps falling down, which the reasons for gold's fall has been on the kind of, you know, lack of safe haven demand. With the potential of COVID-19 having a potential vaccine, gold's safe haven demand is waning. Okay, we're also seeing some downside in platinum, and now looking at bond yields, you see bond yields, we always saw that they were down, but we can see that they've come down from some of those loftier highs. Canadian bond yields, Aussie bond yields, UK bond yields, everything just falling a little bit lower. And as a result, we have that risk of bias. Let me just see. Yeah, we'll just. Sorry, let me just get my currencies up. What we'll see is we'll see some flows in the currency space representing that risk off mood. Just want to show this to you. Apologies for not having it up on screen. So we see this weakness in the commodity-based currency, which is what we'd be expecting. A little bit of strength in CAD. That's not a surprise. Remember, oil's got its own external drivers, particularly at the moment, with the extent of which it's been pressured. We've also got Swiss franc and Japanese yen are also a little bit lower on the day. We would expect some more strength from the Swiss franc and Japanese yen. So that's perhaps a little bit surprising. But we have the broad weakness in the commodity-based currencies. So taken as a whole, the risk tone is still firmly off. So we would expect falls in the Australian dollar, US dollar currency pair. We can see the dollar index has been firmer on the session as a result of those negative news flows. Now, the only thing to be aware of, and this is a kind of important thing, because it's just to be aware of that the market is kind of mixed at the moment. There's positive news flows and there's negative news flows. Now, as a learning point, we can see that the market has decided to focus on the positive news flows. So it's been COVID-19 vaccine positive trials boosted risk sentiment. So we've seen a weak dollar and we've seen stronger Aussie, stronger New Zealand dollar. That's kind of, you know, what we'd expect. However, we've also got negative risk flows on US-China trade war. So in other words, we're balancing these two stories. So what it means, we have to be flexible, ready to shift our positions. It's not like there's a clear bias that's going one way. It's a mixed bag. So you just have to bear that in mind as you're trading. We, of course, will update you when there's any sentiment shift. We'll keep you updated and let you know. But you just need to be aware of it with yourself, with your own trading, just in terms of your own development, understanding that markets are different. It's a bit like the sea. You know, sailors say, you know, the sea never looks the same way twice. There's calm sailing, there's choppy waters. Sometimes it's blue, sometimes it looks gray. The sea is always changing. And it's a little bit of a similar concept in the market. This is a you know, a tricky condition where you might have to change tack quickly. So be prepared to stop, even reverse your decisions. So pairs that you are selling, you may quickly find out that you end up buying and vice versa. So just to be aware of that in the situation. Okay, so let's now look at risk events coming up. Now, there is one risk event that's standing out coming up. I'm just going to go back to the economic monitor and we'll have a look at the US initial jobless claims. Now, the US initial jobless claims are going to be potentially market moving, so it's worth being aware of those claims that are coming out. Now, 2.4 million expected, minimum expectations are 1.7 million, and maximum expectations are 2.75 million. So if we get expectations which are above that 2.75 million or below that 1.7 million, that's potentially market moving. Now, just taking a look at the, here, let's have a look at the, oh, here we go. Having a look at the previous claims, we can see there's a general steady downtrend. So the market's wanting to know, is that downtrend carrying on? Any sort of peak higher is going to be negative for risk. So just to be aware of that, that's something that could turn risk sentiment further off and will increase claims for US economic stimulus. Remember that there is an element of politics coming into this now, because if the amount of borrow, I think if you look in the news report here, if you just look in the must read section, there was a really interesting political point to make here. I'm just going to show this.
Japanese PM Abe, it says plans to offer financial support to Turkey. Japanese PM Abe says
yeah, here it is.
To offer financial.
Here it is, here, just at the bottom. Let me just, have I seen this correctly? Oh no, it's on a different report. It's here, but it's not on this report. And basically, it's just being aware of the fact that President Trump has borrowed a lot more than President Obama did in 8 years. President Trump's borrowed it in 4 years. So there's becoming some tension with the within the Republican Party that President Trump and the government are borrowing too much money. So just to be aware that if it is a negative jobless claims, there will be clamours for more money, but then there's going to be some tension within the Republican Party about issuing more money and looking for different ways of addressing the COVID-19 induced downturn. So just be aware that that itself could invite political comment. It could get more complicated than we necessarily can foresee at this time. So just be aware that jobless claims coming out, maximum expectation is 2.75. So anything above that 2.75 could tilt risk off. So be aware of that. You see the ranges are narrowing now. At one stage we had huge deviation, different ranges. Now we're narrowing it down to 2.4 million. So just don't forget, that's a key data point out at 1:30. Aside from that, we also have manufacturing PMIs expected to be 38. Again, not necessarily particularly market moving. This is for May, and obviously it will be expected to be a bad figure. But just be aware of the manufacturing and services PMI flash outs for the US as well. Aside from that, it's going to be a quiet session for the rest of the day in terms of economic data releases. And don't forget the speakers that we have, some Fed speakers as well during the session. So just keep an eye out for Federal Reserve Bank. John Williams is speaking, and we also have Jerome Powell with opening remarks on online event. Nothing expected on those, but just to be aware with a couple of Fed speakers out later on in the session. So with that being said, our biases remain Aussie US dollar to the downside, Euro US dollar to the downside, Pound US dollar to the downside, and New Zealand US dollar to the downside, as well as Aussie Japanese yen downside as well. So this area here can be considered suitable for shorting as well. So a couple of places where it's possible to short, and a little bit of discount here from the Euro US dollar sort of moving higher. Seeing a bit of movement now, weakness in the dollar. Just check if there's any reason for that that's coming across the wires. It will be covered by Dan or Arno. So anything that does happen during the webinar, you will get the updates in the terminal. Okay, guys, that takes us roughly to where we're at. Sorry, that's a little more long-winded than usual, but it's this choppy waters that's the issue, and just wanted to really get that understanding over to you to help you in it. Now, I'm going to work through the questions and answers now to see what we have in terms of questions and answers. So first of all, Sharia. Yeah, hi Sharia. Yeah, I'm doing good, thank you. And not enjoying the lockdown, but bearing up in the lockdown fine. Okay, my broker are temporarily increasing the minimum margin requirements on Swiss franc pairs only from tomorrow. Are you aware of any specific volatile news fundamentals happening tomorrow? Oh, okay, interesting. Now, only for tomorrow. Temporary increasing. Is it only from tomorrow? What I think is happening here, Sharia, is, we'll just go to the Euro Swiss franc pair. There's been increasing chatter about the Swiss National Bank intervening in the currency pair, okay? Now, the problem the Swiss National Bank has is that they have a strong export economy. Now, their export economy means that a strong Swiss franc means it's more expensive for their exporters. So it hurts the exports through having a strong Swiss franc. So the Swiss National Bank want to weaken the Swiss franc. They want a higher Euro-Swiss franc exchange rate. So the market's aware of that. That was why in 2015, they kept this 1.20 floor. And they did that in order to defend their export market. Ultimately, they couldn't do it, and the whole experiment failed. So famously, there was that huge drop as the peg was removed. Now, with prices making their way back down to these kind of crisis levels, what we're seeing is some more chatter's been going on saying, oh, will the Swiss National Bank intervene in the Euro-Swiss franc currency pair again? Now, they have been intervening, and you can see that on the sight deposits, which are released each week. And the sight deposits have been increasing. So there's speculation growing that the Swiss National Bank, maybe they'll wrap up their interventions. Maybe there'll be another defending of a level. Maybe they'll just say, oh, we're going to defend the 1.0 level. So this kind of speculation is growing again, Sharia. So what markets got, some brokers actually went out of business. I think it was FXCM, went out of business on this peg being dropped. Because what traders were doing, they were like loading up here with like, 100 lots long with a, a 10-point stop loss just underneath the 1.19, 90. So putting, buying 100 lots at 1.20 and then, selling with a stop at like 1.1990 because they were so sure that the Swiss National Bank would hold the floor. And some traders didn't even have stops and huge amounts of leverage. And so when the peg was removed, there weren't enough orders to fill those stops. So some people ended up having negative balances, and those negative balances got passed on to the broker in many cases. And as a result, that was an absolutely devastating day for many people, Sharia. So that's what Oranda are scared about. They don't want anything like that to happen again. And with the chatter around the Swiss National Bank, that's probably why they're changing their margin requirements to cover that. Shibin, you were short on cable yesterday, but due to the better than expected PMI data from this morning, it's retraced back to my entry. Overall positive trade though. I'm thinking I shouldn't re-enter since pound is up across the board. How can I ratify this decision, whether to enter or stay away? The 4-hour bias is still negative from my point of view. Any pointers appreciated? Yeah, sure. Well, okay. the bias for the pound should remain pressured. You've got Bank of England's Bailey, who's been making some negative comments. Well, not negative comments, he's been making some more enthusiastic comments, I should say, about negative interest rates. So if the Bank of England does adopt negative interest rates, that would pressure the pound. So any return up to this level here should be finding sellers because of this negative sentiment from the Bank of England's Governor Bailey. Also, when we look at the actual PMI data, although it was positive in the sense that the numbers were an improvement from the really shocking April data, let's just go and have a look here. So the numbers were an improvement from the shocking April data, okay? But just to be aware that the way that the PMIs are constructed is that they ask people whether they're seeing conditions improve or deteriorate. So because last month plunge was so bad, this month seems like at first sight seems like a V-shaped recovery. Yes, it's an improvement, but the message from the overall press release is that these figures are still far worse than anything seen before the virus struck. I think it's something like, it's a 40-year low. Let's just have a little look in, UK factories report biggest output drop in over 40 years, okay? So although at first sight it's positive and the pound did rally, in the bigger picture, the UK's situation is still dire. The recovery is likely to be very slow, and at the bottom line is we're going to see a steep drop in UK GDP for the second quarter, and that could be around 15% GDP drop. And the expectations by some analysts is that the UK economy is not going to return to pre-virus size until 2020. So with social distancing still going to be a way of life for the UK, remember that the UK still got, second highest death rates, fourth highest cases in the world. Social distancing will last for some time. It's going to be a while before UK gets back to normal. So with the more negative risk tone that we've been seeing in the market, with the dollar strength, we've got some dollar weakness going on now, so we obviously will keep monitoring that. But the dollar strength we've seen, I don't know, there's a reason for that, but the dollar strength we've seen has been on those risk off tones. So as a result, we would expect pound US dollar sellers, and it's it's suitable to sell from that level. So I hope, Shebin, some of that helps. So you can't, that can be kept as a short. Yeah, Augustine, the choppy market, difficult to trade. Yeah, exactly. Yeah. View on the pound yen. The view on the pound. Let's have a look. Cortez. There's reasons for pound weakness, and there's reasons for yen strength. So pound yen, I'd favor pound yen shorts at the moment. With the risk off tones, you'd expect yen strength, and we'd expect pound weakness on Governor Bailey's comments. So that would be pound yen would have a short bias for those reasons. Yeah, Nurbeck, hi. Yeah, pound, okay, Nurbeck's just saying the pound's rallying higher after a little positive UK PMI data. Can the upcoming neutral US jobs claims support it further? Yeah, I think the key thing is because risk is so much in the balance, what we've seen so far through this week is that negative news has been discounted. So we had the negative stat news on Tuesday, and then we've had the negative US-China, trade tensions. Now, if we get, a better than expected US jobless claims, Could that support risk? Can it support the pound? If it's better than expected, you might see some US dollar weakness, and then you might see some pound US dollar buying is possible. But no, but the way I'm reading the markets at the moment, the bias: sell pound US dollar, sell euro US dollar, sell New Zealand US dollar, sell Aussie US dollar, because there's reasons for dollar strength as we've outlined. So I think that's the, you know, the tone, the risk off tone is clearly here in the market, and until we get a change in that risk off tone, it will most likely need another catalyst. Could the jobless claims be a catalyst? Yeah, it could be, but it could also be a catalyst for risk to turn off. So definitely one event to be aware of. Rajiv, it's good afternoon. The biggest market mover is dollar index that is dying. Equities making fake green moves. Aussie pairs helped by their banks who are pumping in. Do you think Dixie will go lower than 80 level? What are the points that will strengthen the risk tone? Okay, so the things that will strengthen the risk tone will be two things. One, if the COVID-19 vaccine, more positive news. So say Moderna release a new set of data that, you know, reacts to some of the stat news reports. Perhaps they release more detailed data, more in-depth detail. Anything like that will be positive for risk tone. Secondly, if US and China suddenly say, you know, we've made friends, we're looking forward to a great future together, or if President Trump suddenly had a change of heart and said, you know, we need to get on, we need to work together with China, don't blame them for COVID-19, that kind of thing, that would also help at risk. So where the dollar index goes next will be decided on that risk tone. So you remember, Rajiv, in a risk-off environment, the dollar is a safe haven currency. So the dollar moved a lot higher in March as the COVID-19 outbreaks really took root on that safe haven status. Then the Fed opened up some new swap lines, and we had the unlimited quantitative easing, and that all helped to weaken the dollar. So the dollar should be going weaker if market calm returns. Okay, so you expect the dollar to start falling. So you need those two things: COVID-19 vaccine and positive US-China trade talks are the two things that would help the dollar index. At the moment, we're still in that negative sentiment from US Senate passing a bill which actually has action to it. It could delist Chinese companies from the US exchanges. That's important. And China is pushing back to do with the US's involvement in Taiwan. That's important as well. How can the Dixie be so strong? It's for those reasons, Rajiv. Remember, the key to understanding the dollar at the moment is it's acting like a safe haven currency. So the same way that the Swiss franc and the Japanese yen acts in a safe haven environment, the US dollar is acting exactly the same. So just to be aware of that. Yeah, good, Jebin, I'm glad that helped. Hi, Richard. Yeah, okay. Can we look at New Zealand dollar CAD short? Let's just pull up the chart and then we'll have a look at that. Right. CAD's holding strong in oil prices, yes. But New Zealand dollar seems supported on recent RBNZ comments saying negative rates are not necessarily close. Yeah, that's correct. I took a short prior to RBNZ comments on supported oil prices, but holding onto a loss at the minute, so it seems like a neutral bias. One of the risk off tone could turn in my favor. Yeah, I'm with you. Right. Yeah, I follow the logic. Yeah, I follow the logic. Now, you've got a good supply level up here. So you obviously found some selling into that supply level. Oil prices are supporting CAD at the moment. You're absolutely right. And they're grinding higher. So that's supportive for CAD. Now, looking at the New Zealand dollar, yeah, it was those comments by, yeah, you're right. It is a neutral bias. You know, if you were looking at it today, you'd say there's reasons for New Zealand dollar strength and there's reasons for Canadian dollar strength. If there's a risk-off tone, it could turn it in your favor, but only in the following circumstances, Richard. If the things driving oil higher remain due to external factors, because oil tends to move with risk factors anyway, okay? So that's one very important area to look at. So if the risk-off tone does change, it could result in a neutral bias for New Zealand dollar, Canadian dollar anyway. However, if the oil factors, things driving oil higher, remain in place, and then you get, like, you know, dollar strength on some more negative US-China comments, then that will pull New Zealand US dollar down lower and pull your New Zealand dollar CAD. So it's a tricky one. In your favor, you've kind of got this key level above, haven't you? So in your favor, you've got this key trend line and a key resistance level. But I think the way you're reading it, Richard, is exactly right. It's basically a neutral bias, and risk-off tone could turn it in your favor, but it also could not if it hit oil as well. You just carry on getting some more of this range-bound action. So I'm sorry I can't be more helpful than that, Richard, but that's the way I'd read managing that. Yeah, Richard, that's, you know, if that was me, I think, and I was sort of, you know, in your shoes, that, I think that's what I'd do. I'd have that, you know, have that resistance zone. It's like, okay, that's my line in the sand. And then, you know, things may pull you away, and just leave it at that, or just pull it now and say, do you know what, I don't want to take an extra 80-point loss. The pair is now neutral. You know, so. Okay, what are your views on the institutional Euro-Swiss franc short trade highlighted yesterday? Let's have a look at that. Trade ideas, Euro-Swiss francs. Okay, let's have a look what it says. We think the probability of the SNB stepping back from its soft 105 defense is increasing. If that level goes, then the risk of a sharp move lower is also significant. In 2015, the official move on the day was 35 big figures from 1.20 to 0.85. This time positioning is likely a lot less, but still 10 big figures seem reasonable, hence our target of 0.95. Yeah, so this is what they're doing, Honto, is they're doing what some funds, not many, were doing, shorting Euro-Swiss franc into the 1.20 floor. So they've got the same rationality. They want to try to challenge the SNB's willingness to hold that floor. So there's been chatter around that, you know, that is a soft floor, that 1.0500 is is like the new floor, okay? So a soft floor. So they're not, you know, it's not that they've said we're going to guard this at all costs, but that's kind of seen as a level. So they favour that short. My view on it is it's quite speculative, because a lot of it will be based around the COVID-19 virus and whether we pick up out of that. If we pick up out of that, we'd expect the euro to quickly recover and start moving forward. So, you know, the logic is good. It's just quite a, you know, a big trade to hold, and there's so many variables. You know, will COVID-19 pick up? Will the SNB intervene? You know, some people might just say, you know, given how volatile the Euro-Swiss franc can be, just stay away from the pair altogether. you know, some traders won't even trade the pair given the fact of what's happened in the past. Yeah, the euro strength, James, right? You would have seen that euro spike. Now that was on that spike higher in the euro has been on the joint German-France euro kind of relief fund that's been proposed. There's been a fund proposed. Now, if you just look in the terminal, we've got a good outline of this. If you just look here, does the EU recovery fund proposal change the euro bias? So basically what's happened, James, is that Germany and France have proposed this 500 billion recovery fund package. The idea is going to become a grant to struggling businesses, but it hasn't been voted on yet. It has to be voted by all the 27 countries in the EU. Chances are, like some of the more strict or stringent countries like Sweden and Austria will be reluctant to get involved with a grant. They might want it to be a loan, and it's driving the euro higher. Now, it doesn't change the situation. It's a potential positive for the euro, and just makes the euro mildly bearish rather than very bearish. So that's what's happening. That's what's happening there, James. Rolando, oh yeah, just a comment, thank you. I've read that Westpac pushed back its call of RBNZ negative interest rates to April next year, so I see more sideways on New Zealand dollar. Yeah, thanks, Rolando. That's helpful after that Governor Orr's comment. He just pushed back the expectations. It was funny though, because you're reading what Deputy Governor Beshan said. He just said, we're telling banks to get ready for the end of the year. So I think markets were getting ahead of themselves a little bit, and I think Governor Orr was just stating really what should have been read through the Deputy Governor's comments, that it's sometime but not yet, potentially. Yeah, okay, James, that's good. Okay, I was going to go through if there's any other questions that I've got here. Just going through. Yeah. Yeah, great. Okay, well, thank you very much, everybody. It's been really good as usual. Thank you for attending, and I wish you all good success for the future session. The final words I say is that, these when these markets are a bit choppy, it's choppy, but the bias is to discount the negative news. That's if you had to put in a sentence, there's reasons for positive sentiment, there's reasons for negative sentiment, and the market so far has been discounting negative sentiment. So that's just something to be aware of. But the risk tone is still negative, but just keep that in your mind in these choppy markets. And I wish you all a very good afternoon. Yeah, thanks, James. Yeah, you're very welcome. Thanks, everybody. Take care now. Goodbye.